All right, folks, this is probably the most important video you can watch today. I'm going to talk a little bit about rates, what's going on with everything, and try to put things in their proper perspective. A lot of information out there, some of it good, some of it bad, but I thought that I would share my 23 years of knowledge with you guys. I've had some great conversations with some leaderships, not just here at Acopia, but at other companies as well. So I'm a little bit privy to some information. But so guys, let's start with the Fed rate. I want to tell you right now, when the Federal Reserve meets and they adjust rates, that is not the indicator that we use in the mortgage business to kind of track what's going to happen with rates. So going forward, don't put any focus on what the Federal Reserve does, whether they lower rates or raise rates. That's what the big banks borrow money from big banks on a daily basis. And like I said, it's not really indicative of what's going to happen with mortgage rates. So next thing, guys, here's what's going on. All right. In the mortgage business, we follow the 10-year Treasury. The 10-year Treasury has been historically a good indicator for us to kind of gauge what's going to happen with rates. So let's put some things in perspective. You know, we've been in the historically low rate bracket for a very, very long time. Last week, we saw, a big downturn in the market because of the coronavirus. What that causes people to do, you've really got two types of investing. You've got equities, the stock market, things like that, a little bit risky. And then you've got things like treasuries and the bond market, which are, considered relatively safer than equities. So if you look at what's happened in the stock market, you've had trillions of dollars coming out of it because of the coronavirus. People get scared, they panic, they make moves, whatever. So where do they put that money? Historically, and this is what's happening now, is those folks are taking that money out of the stock market. They want to put it someplace safe. And historically, treasuries and the bond market are where they put their money. It's as simple as that. So when you have all of this money, and we're talking a ton of money, pouring into treasuries, which is what we in the mortgage business follow, then it's kind of like the law of supply and demand. You just have more money. So the yield goes down. Now let's talk about the yield. If we were to look at what the yield has done over the past, say, 12 months, 18 months, it's been anywhere from 150 to 200. And rates in that time have still been anywhere from, 3.25% to 4%. So we're still in a great situation as far as rates goes. Now, last week with, the drop in the equities and the 10-year Treasury going way down, we saw as mortgage folks, we were like, oh my God, it's going down. Rates are going to get better. And we actually saw that. Okay. But Friday, there was so much volatility in the market that lenders, servicers, banks said, whoa, wait a minute. And I mean, locks were suspended, pricing was suspended. And so here we get to Monday, Tuesday, Wednesday, and we've seen rates actually go up. And the 10-year Treasury yield really hasn't moved a whole lot the past few days. It has up and down a little bit, but not a whole lot. So how did we get from 2.75 or 3% last week to where we're at right now, 3.5%, 4%. I've talked to some folks, they're as high as 4.5%. Guys, the powers that be, the investors, the servicers, the banks, they got together and they said, hey, we've got to put the brakes on some stuff. So maybe what we've seen, and we are seeing this, is runoff on banks and investors and servicers, primarily with their pipelines. And in lieu of that, there's a ton of origination going on too. There's a lot of origination going on out there because people want to take advantage of these rates. Now, what that means to the servicer, guys, is those loans on their books right now, they're going to be refinanced. They're going to come off their books, and while they may make it up on origination, they're still going to lose money. Banks cannot handle the influx of business that they are seeing. So we're seeing some banks actually raise their rates. Some banks are doing some creative things to go ahead and offer their customers pretty much a no questions asked option to lower their rate. At the end of the day, guys, here's what I want you to know. Like when you're going through your life, everything's really good, okay? And then something happens, a major event in your life, and then things become chaotic. What do? We take a break and we regroup and we get our stuff together and then we move forward. So that's kind of what's happening now. Across the United States, the big power players, they're meeting, they're coming up with plans. I personally think that we'll see rates drop back, to where they were maybe a week ago, possibly even lower. But to move forward without taking a step back in this case could be extremely detrimental to the industry as a whole. So, we're just taking caution right now. Most banks, most mortgage companies are in the right position. Some of them are not in the right position for this kind of volatility. And we might see some folks closing their doors. We just don't know yet. But Whitney Hall, Mr. Loan Guru, and Acopia Home Loans are here for the long haul, very confident in our ability to keep pushing forward. You may see some slowdowns with some other segments like appraisals, what have you, and title companies, because there has been, I believe, I heard from one company that in the first 7 days of March that they locked over $73 billion in loans. So guys, be cautious. I think what you want to do right now is just be educated and be prepared. Sorry for such a long video. Hope you find the information, useful. If you have any questions, I'm always available. Folks, have a great day.